Need live participation. I want to find out what you guys think about the housing market today versus 2008. I want to kind of I love participation in this platform because I want to figure out what you guys are thinking, because I'm trying to get in the minds of home buyers to see, are you contemplating buying? If not, the whys. And the one piece of the puzzle that I really wanted to dissect is the differences between 2008 in today's market. So many people just keep coming in and saying, well, the market has appreciated so much that it has to crash. Well, it doesn't have to crash. And that's the whole reason for today's event. So I want your participation. I want to know your questions on why you guys think the housing crash is going to take effect. And then what we're going to do is compare some differences from where we were back in, say, 2008 versus where we are today. So let's get over to one of the charts that I want to show you guys. And this is something I put together in a previous video that I did, basically just giving you some content on, where we were back when and where we are today. So if you look at this context, you can see back in 2010, I've got to put my glasses on. I'm an old fella. Remember that. Back in 2010, we had the number of first liens versus today is, in today's market, we have $53 million worth of mortgages right now. So sorry, my secondary screen's a little bit hard to see. The average FICO back at the crash. So my contentions here are, let me give you an idea of what avenue I'm going down. I want to explain to you why the crash occurred in 2008. Okay, and why those elements that took effect in that time frame are much different than where we are today. Today's market is basically the Federal Reserve dropped rates to the lowest rates ever in history. Then we had the federal government pumping in trillions of dollars in the stimulus money, and so thus created excess cash flow for everybody, excess disposable income for everybody, and that's what basically created the housing bubble that we're seeing today, as well as inflation all over the board. So what we want to talk about today is the differences between 2008. That's basically when everything imploded. But what we have to focus in on this is what took us up to that point. Okay, so let me retract you a little bit back in history. What we've seen over this pandemic period is we saw the interest rates drop to record lows. We had the federal government coming in and stimulating the economy. And the lockdown was a big contributor to the housing boom, believe it or not. And it's as well as the assets that people had. People saw stock markets driving up to record highs. We had cryptocurrencies where we had multimillionaires from kids. I even know teenagers that are multimillionaires to this day because of Bitcoin. But what we want to dissect is, okay, we know what happened this time. It was just supply, demand, the disruptions, the COVID, and everything. But what are the differences between today's market and back what we saw in the early 2000s? So let's start asking, please guys, ask any questions that you guys have, because the event is for participation. I want to know what you guys know or what you think you know and why you think the market crashed at that point. And I'm going to go through every comment that is posted. If you guys, when you come on board, if you would just let me know where you're coming from. Orlando Vargas, he just posted on here, and I'm going to bring up these comments as we show them. But I want to know where you guys are coming from. And if you have a question, please put a Q in front of the question before you ask it, so then I know it's a question. But so we have Orlando saying that it is going to be 2008 all over again. So Orlando, since you put yourself on the hot seat, can you explain to me why you think it's a repeat of 2008? But in the meantime, while you're doing that, let's go through some of the context of where we were back in 2008. So let's go over this. So back in 2008, the biggest culprit, and you could do Google searches. Hey, Michelle, I see Michelle from Tinley Park. Welcome, join us again. The reasons for the debacle or the crash in the 2000s were this, and it is one main thing. Okay, it is subprime mortgages. And if you don't believe me, go back and do as much research as you can. But today's event, I'll direct you to some of those areas and to define or answer any questions that you guys have. But the subprime market back in those days was this. If you had a 580 credit score, you could basically get a loan. We called it, if you could breathe, if you had a heartbeat, you can get a loan at that point. The federal government at that time said that basically everybody out there should be a homeowner. Well, I'm not even in agreement to that. Everybody should not be a homeowner. Okay. Thus, what was created was these instruments that they consisted of this. They dropped the credit scores to get more and more people qualified. Okay. Then what they did is to even exponentially expand that program is they stuck a steroid needle in it and said, well, not only with that credit score that you can buy your first house, you don't even need any money, because what we're going to do is we're going to do a combination of one or two loans. We're going to do 100% financing on your loan. We're going to do it as an 80-20. So if you go back, just Google search an 80-20 loan, and you're going to see back in 2006, 5, and all those, that was the number one product out there. So what happened was we drove down the credit scores to a level of about 580 to 600 as the norm credit score. Okay. Then what came about in that is they came out with programs that are called NINAs, no income, no assets. Basically, if you had a job, you could basically buy a house. And then in that, if you listen to what I said, is no income. So you didn't have to verify your income. I remember being an underwriter at that time, and I was also a salesperson, and I wore many hats. I would go see mortgage brokers at that time, and they would have a back room where they would just create VOEs and such. So there was fraud running rampant in those days, as well as, again, the no income, no assets. So we had people that were secretaries, nothing against secretaries. They were, servers at a restaurant, nothing against that. But they were coming in with, and they needed a qualified income of, let's say, $200,000 to qualify for the property. That's fine. It's reasonable for a receptionist to make 200 grand. It wasn't verified because, again, with the name of the product, no income, no assets. So they would put you into a primary loan. The first loan would consist of an 80% of the house's value, and they would put that on a teaser rate. Okay, it was this payment option arm. Okay, and then what they would do is they would piggyback a second mortgage on that program to fill in the void of the buying the property. So you owe 100% on the house. So let's say you buy a house for 300 grand. So you do an 80% mortgage as your primary loan. That'd be 240. And then you would do a $60,000 home equity loan second to piggyback. So you would need no money at the closing. Okay. But here's what happened. People consistently did that program, and as house values escalated, they would refinance, and they were using their house as basically an ATM machine. So Google that even term, house being used as an ATM machine. I bet you're going to come up with a time frame of about 2005 to 2008. So people would repeatedly just keep turning those loans because they just wanted to get more and more money out. As their house would go up in value, they would do another loan, pull out all that money. So it was a repetitive circumstance that was going on. Then what happened is loans started to reset. So we had loans, there was millions of loans out there, and I have a number here. I'm going to blow this up a little bit so you guys can see this. Let me see if I can do it right here. I got to show this to you because this is a really important form I want to go over with you guys. If you go over this right here, you're going to see risky loans. Back in 2002, the average, or today's loans, the average credit score is 751. 2010, the average credit score was 629. Riskier loan programs. In 2010, there were $13 million worth of adjustable rates out there. And ARM loans at that time consisted of let me backtrack. In 2010, there were $13 million worth of the negative AM loans. Today's market, we have about 2.5 million. Back then, when the housing market imploded, that year, 1 year alone, we had 10 million homeowners were on adjustable rate teaser loans. That year alone, 13 million people had those loans. 10 million of them reset in 2010. Okay, so let me break this down. I know it got a little bit confusing. So you take out a loan in like 2004, 5, 6, 7, whenever that is. It usually has a 2, 3, or 5 year lock on that rate. Then after that time frame, your rate would start to adjust. Well, remember, there were teaser introductory payments, interest-only payments, no non-amortization payments, all this to drive down that payment the lowest possible payment that there could be. Okay, so then in 2010, when 10 million residencies or 10 million mortgage holders, 10 million homeowners saw their interest rates adjust, in most cases, the payment would double. Some cases it would triple. So now all of a sudden people don't qualify, okay? But people have 100% of their equity out in their home. So now you get the mortgage payment. You can't make the payments because your mortgage payment escalated. What do? You can't refinance again because the market's starting to implode on itself. At this time, too, lenders were starting to pull out of the market. Okay, close down for good because of just bad underwriting standards. It wasn't because nobody wanted mortgages. It was basically they were going out of business because they just had crap loans. Okay, so that's what was taking place at that time. Okay, so what's happening, what you see now is a shift in these products. So we have, in today's market, there's 1 million people that have adjustable rate mortgages compared to 13 million that had it back in those timeframes. Okay, so if you bought a house now and you have a fixed rate, your payment is never going to move. Well, you're going to have people contradicting me saying, Dan, yes, it is going to go up a little bit. Well, so here's what happens is part of your payment includes your loan payment. And then part of it includes your real estate taxes and your homeowner's insurance on your house. So the loan piece of the puzzle is never really going to move. Okay, it's a contracted rate and payment and so forth. So that mortgage payment isn't going to change because of the loan. It's going to change because your real estate taxes either went up or down, or your homeowner's insurance went up or down. And usually on a yearly basis, it might go up, a couple $100. So let's say your mortgage payment goes up, $100 a year. Okay, so that's what's happening today. So if you've purchased a house, you don't have to worry about mortgage rates. Okay, so you don't have to worry about your payments going up. All right, but let's say you got behind. Let's say you're struggling. Let's say something happened. You're getting divorced. Something happens that's pushing you into the brink of you have to do something. Okay. Well, in today's world, you saw in this morning's video, we have parts of the country that are still appreciating at the tune of 30%. But let's take that out of the equation. Let's just go over the last 2 years. We've seen house prices in the last 2 years go up about 30%. Okay. So that means that, you have equity built into your home. So in today's world, here's the last stat I want to go over with you on this chart that I just did, is there is 11 trillion in tappable equity for homeowners. Okay, so homeowners right now have 11 trillion in tappable equity. What that means, it's on top of the 20% you would have needed for your down payment. Back in 2004 or 2008, when everything imploded, 1 out of every 4 homeowner was underwater or owed more on their mortgage than they did, owed more on their mortgage than the house was worth. Okay, so at that point, you can't sell the property because you owe what it's more than it's worth. So you would go into what's called a modification with your mortgage company. You would go into short sale proceedings to just try to dump the property and see if the bank would take whatever you could get for the property. So that created the whole implosion. So you had people selling on top of selling on top of selling. Well, nobody wanted to buy at that time because we were seeing it happen in front of our eyes. Nobody had any equity. And houses just kept dropping and dropping and dropping. And a lot of properties were bank owned. Remember, 1 out of 4 properties were underwater. So meaning they owed more on their house than it was worth. So the banks took those over. What did the banks do? The banks don't want your home. They're not a realtor. They would put these houses on the market at cut rate prices to dump them fast. So houses just kept coming on the market and on the market and on the market. Nobody's buying because no lenders are even in business at that time. Everybody was basically shut down. Look at Morgan Stanley and all the big major players on Wall Street at that time. They even crumbled. That was one of the first times in history, other than the great, the Black Friday, that companies of that size went out of business. So now let's reflect back to today's market. So we see today's market. If you got a mortgage in the last 2, 3, 5 years, you probably have a rate about 3 or 4%. Okay, so rates have never been that low in history, and they're probably never going to get that low again unless the Federal Reserve really screws up. But so we have record low rates. So and very little adjustable rates. So people don't have to worry about, at some point their mortgage payment getting or doubling in price where people can't afford that anymore. Okay, so that's going to relieve some people from getting that shock in the price of how much their mortgage payment is going to be. That's number one. Number two, there's no more shoddy loan products. Okay, it's conventional FHA, VA, thorough guidelines. And if you do have to go outside the box, what they call non-QM, most non-QM programs require minimally minimally 10% down. And if you're looking for a rental property, it's usually 20 or 25% down. So you have to have a lot of skin in the game. Remember, these aren't products that are allowing 100% financing. That's the big key. Okay. So then next, what is another piece of this puzzle? Well, I'm in the mortgage business. Okay. At that time, people were calling daily to get refinanced, to do something. All right. But no banks were lending because they were all going belly up. Well, now you're going to say, well, look at all these mortgage companies going out of business now. Well, you're not seeing, Morgan's, some of these big Wall Street firms going out of business. You're starting to see mortgage companies, not banks, not, those big entities, investment advisors and so forth going under. You're only seeing mortgage companies starting to fold. Why? Well, they got really fat over the last 3, 4, 5 years. They got into these Taj Mahal offices, hired everybody and their mother. People were making tons of money. And now all of a sudden our volume just decimated. Because why? Well, mortgage rates just doubled and they're on the brink of tripling just this year alone. Okay, so we also have housing values going up and up and up because of supply demand. Okay, so now what we're seeing is more supply coming into the market. That's going to help things tremendously, but these rates are just killing everybody. And on the last word of this, and then I want to open up to everybody's questions, so please start asking questions, is the foreclosure piece of the puzzle. So I see videos every day and people talking about how foreclosures are up 1 billion% from where they were and everything else. Please watch some of my videos that I did, and I'm going to try to re-edit this video to put some captions in here, but I'll put some videos down below and check out some of the other videos that I did. The foreclosure rate right now is basically the lowest it's almost been in history, okay, ever coming out of a pandemic. You would think that nobody was working, nobody has any money, people are struggling, everything else. Well, in this morning's video, I also showed you how how Americans have had the most disposable income ever in history in 2021. Well, how can that be if basically nobody was working, everything was shut down? Well, it's because the government stepped in as well as the Fed. They're both at blame, pumping tons of money into this money system. The Federal Reserve was pumping money into the money supply, and then the federal government's just just using money they don't even have to send that out to everybody and anybody that just, might, even people that didn't need it. So that's the context that I really want to put in today's market. So when people say, well, the housing market has to crash, because I'm all ears, because I want your thoughts behind it, not just saying, well, the house prices are too high and rates are too high. Well, people need a place to live, okay? You can also check out rents. So if you need to buy, here's my question that I have to people, and then I'm going to go answer questions. If you had to live somewhere, you can't live with mom or dad or in somebody's basement. If you had to live somewhere, would you rather own or buy? That's only your decision to make. But you're also seeing in today's market, rents are going up in the tune of about 20% a year. So if you continue to rent, where are you going to be in 3 or 4 or 5 years? You're never going to be able to afford it. Where once you buy, and I'm not a proponent of buying right now. I even said that. Would I be a buyer today? No. I'm waiting for all this to settle down. I'm waiting for more inventory to come to market, and I'm waiting for a recession to be officially declared so we can see mortgage rates coming down. And I'll have a nice video out. It's going to be out in the next week going over. I have one fantastic option on how you can get the seller. If you're looking to buy a property, how we're going to get the seller to help you out to drive down your mortgage payment substantially over the next 2 years. So let's get over to the questions that you guys have. I'm going to try to get to everyone. Please watch what you say, because I don't have a moderator today and I really don't want to get in trouble with YouTube. So let's start going through. We got Tinley Park, Little Village. Thanks, guys, for posting here. And I appreciate you guys coming on midday. I'm sure you're working and things are pretty hectic. Given the current state of the high rates, would you recommend an ARM or a 30-year fixed? Angelo, great question, bud. Here's the tough thing is ARM rates. I usually am not a huge proponent of ARMs unless the rate difference is pretty substantial. In today's market, it's hard to find a really, really good adjustable rate that's substantially lower than the fixed rates. Why? Is because we saw the inverted yield curve. So let me explain this to you. We have short-term loans, short-term maturity bonds, and everything else having a higher rate than a 10-year bond. Okay, that usually isn't supposed to happen that way. So you have adjustable rates that are tied to shorter-term maturities and shorter-term maturity bonds, and their rates are higher than a 10-year bond. Thus, right now we're seeing adjustable rates almost the same, maybe a little bit lower than fixed rate, but not much more. So I have an option coming out in the next couple of weeks. It's called a 2-1 buy down. I think you're going to learn a lot from this video, and I have calculations and a worksheet that you guys can do on your own. But this is a huge piece of the puzzle if you're out there looking to buy a house right now, or realtors out there. If you're a realtor out there, you have to know about this program, because what we're going to see in the market right now is home prices starting to come down, but a lot of home sellers don't want to admit, I'm asking too much for my house. But what we want to do is we want to go in and talk to those home buyers and say, how about we do this? And we'll give you a full price for the property, but why don't you give us maybe a little bit of a price concession or a credit back? What we're going to use that money for is to help the seller drive down those mortgage payments so they qualify to buy your house. So what do you think of that? So that's what video that we're going to have coming up. But that was a great question, and keep them coming, guys. But if you guys would, please, as you're on here too, you need to help me just a little bit with the YouTube algorithms. So if you can give me a thumbs up or participate any which way, it helps YouTube algorithms, helps us get noticed. So I'd greatly appreciate it if you guys did that. Last time the housing market brought the economy into a toilet. This time it's going to be vice versa. Housing market. That's probably a very good analogy of this. Last time the housing market crushed the economy. Now the economy is crushing housing. I'm going to have to use that. Orlando, I might have to send you some royalties if I start using that, buddy. But thanks for the question. Next question we have is, high home prices, high interest rates. You must be stupid to buy a house these days. Okay, let me flip this around. Let's say it the other way. Okay, you're renting right now, and you keep giving your landlord your rent check, and your landlord is using that to pay his mortgage payment on the house that you're living in, providing him equity in the house. So then what happens next year? Well, your landlord has a 30-year fixed rate, so his payments aren't going up. They're the same. But next year, he's going to raise your rent 10%. Okay, so that means you're paying him even more. So he's using those payments to drive down his mortgage balance. So less than 30 years from now, let's say 20 years from now, 15 years from now, that house that you're living in, renting from that landlord, is going to be paid off. And you're going to continue to send him rent checks on the tune of, and let's get to it. If we look at the past data for the past 2 or 3 years, rent prices are averaging about 18 to 20% increase year over year. So are you the stupid person if you're buying? Or are you a stupid person if you're renting? I don't know. You guys got to do the math, because what you need to do is focus in on your direct area where you live. Maybe you can find, maybe it's a half hour away from where you live right now, but you can find a house, maybe a small house that you can buy, live in, because when a recession does get announced, the Federal Reserve is going to knee-jerk, and they're going to have to start reducing rates. We haven't seen these rates since basically the 90s. So you see even mortgage people in the business today that have never seen rates this high. I have, because I've done it for a long, long time. And I don't mean to use the word stupid. You brought it up on the screen, but those are my thinking. You can't just say, oh, it's stupid to buy. Well, you're renting and you're paying somebody else's rent, and those rent payments are going up in the tune of 10 to maybe 20% a year. When is that going to stop? And again, when you make those rent payments, your landlord's taking that check and just making his or her mortgage payment. So you're making their house payment. You're making a mortgage payment, but it's not your mortgage and it's not your house. So just food for thought. I'll be the contrarian here, so we could do kind of you guys. And if you go the other way, I'll defend on the other side why I think it's not a good time to buy houses in today's market right now. I got a house for 5.75 in June this year. Sweet. Are you happy? Please leave a comment down below. You could have waited, and now you could be at 7 or 7.25. So that's that part of it. Let's see if we got today's rate. Let's see what we got. Today's rate is 7.25 on a 30-year fix. It depends. So let me go over just how rates get calculated. So if you're new to the channel, we have a lot of realtors. We have a lot of mortgage people that watch the channel, but we also have a lot of home buyers. So there is no the 30-year fix today is X. Okay, there's probably 12 different components in the mortgage rate, or what makes up the mortgage rate. The biggest factors there is your credit score. Okay, how much money you're putting down, what kind of property is it? Is it a single family, a condo, a 4-unit, something like that? And what is it going to be, your primary home, or is it an investment property? Those are the biggest pieces of the puzzle, on top of how much money you're going to put down. So the better your credit score and the more money you put down, the lower your rate. So there's rates that I've seen today are 6 1/8 or 6.5, 6.25. So but there are rates, believe it or not, I can put in some calculations, and I'm seeing rates in the mid to high sevens. So there's a lot of moving parts when it comes to your mortgage rate. That's why I asked you just to call us. We'll give you a mortgage quote. We could basically do it right over the phone with you if you give us all the information. I always say, it's like a puzzle. Give me all the pieces of the puzzle so I can put it together and then give you an accurate quote. But great point. The next piece of this is the next question we have is, terrible rates. I'm happy I got my house now. I'm happy too. I have a 2.625 rate on my house, and I'll be reluctant to sell that puppy in a long, long time because I really don't want to move and go to a 7 or 8% rate. But if you're also new to the market, you probably know that most mortgages only last 7 years. Why? Well, people either refinance, sell, or do something, during those 7 years. So everybody wants to say, well, the housing market's crashing today and rates are high. Well, if you want to look long term, where are rates going to be a year from now and so forth, I can almost assure you they're going to be less than they are now because we're in a recession. Okay. But if not, you just have to make sure it's in your budget. It fits your budget. Sorry, the top of my head is missing because I got lights all over the place. I had to move offices. They're working on the parking lot outside my office, and I can't hear anything. So bear with me on this one, but I appreciate you guys being here. A wise mortgage lender once said, marry the house, date the rate. It wasn't me. Who was that? If you could put that down here. I just heard that just the other day. It might have been Rick Mahone or Scott Walters. I forget who that was, but let us know. It might have even been Jeb Smith. I forget who it was. Orlando, you're on here again, buddy. Thanks for visiting us today. Wait to buy at least another year. The seller wants 2021 for their house and buyer wants 2019 home prices. Yeah, you're right. And that's why I'm a proponent of, I'm going to wait right now. If you have to move or you have to buy or whatever, stick your toe in the ground and wait for a sweet spot. Okay. I did a video this morning talking about home prices from builders. It was funny because over the last 2 years, we've seen these builder contracts come in, and I read them because we had a lot of issues with a lot of them. And in there, basically, here's what it says. You have 2 years to build we have 2 years to build the house. If we get price increases, we're going to pass those on to you. And when we're ready to close, you have to close basically within 24 hours. Okay. Well, their tune's changing right now, but let's go through that verbiage. Okay. It's going to take us 2 years to build the house. Well, in today's market, the supply chains are easing. So they should have your house ready in between 6 months and a year. Okay, so that's number one. It shouldn't take 2 years. The other piece of the puzzle is if you're building a house, I would do my due diligence. I would watch all the material prices. Did you know, if you haven't seen my video from this morning, check it out because I went over the 3 biggest components that it takes to build your house: concrete, steel, and lumber. Concrete is up. It's up. I didn't do the calculations. It's up a little bit. But lumber prices are down 70% and steel prices are down about 30 or 40%. So you have the 2 of the top 3 components that go into housing basically down over 50% in their costs. Well, why aren't the builders, giving those credits back to you? Well, what they're going to do is they're going to say, well, here's our prices, but what we're going to do for you guys, they're still going to make the same profit margins, is we're going to give you a free basement. Well, because they probably just picked up a ton of money in the costs of everything going down, and they could provide those for you. But now they have so many houses that people have basically pulled out of contracts on that they're freaking out because they treated people so bad back then that they're starting to pay for it now. So great question, and I'll keep moving on. So what do we got next? I bought my house because I wanted to build equity. Perfect. And then 10, 15 years from now, you're going to look back saying, oh, I did it. My analogy is this. And I think I said it on a recent video. It was probably harder for me and my wife to decide to have children than it was to buy our first house. My child, I can't take back. Okay. Maybe. But on the house, you have to think this through. So I have a video series coming out. Can I actually buy? Is the name of the series. The first video in that is, can I actually buy my first home? And the first piece of that video is I go through about a 10-minute video just saying, are you ready? And I'm going to poke some holes into your thinking, maybe to make you think. Remember, guys, for those out there saying, Dan, you're just FOMO on all this stuff. Guys, I strive to have you watch these videos that are coming up because I'm just providing content. I'm trying to find you a way on, if you decide to buy a house, the best way to do that. Okay. But in that thing, the first video of that series is, are you ready? And we just drive and drive and drive some details in that video to you guys to actually decide, maybe I'm not ready. Maybe I do rent. And there's nothing wrong with renting, but I wouldn't do that as a long-term equation, because why? It's just not, housing still builds equity and wealth. And if you don't believe in that, God bless you. I'm not even going to try to argue with you on here or debate it with you. Continue to rent and just stay on here, and you might find some more valuable information. But thanks again for posting the comment. Let's see. The next thing that we got here is, please don't buy a house this year. So we have people saying, I bought a house and I'm happy. Other people saying, I don't want to buy a house. So, it's all in whatever you decide to do. I'm under contract right now. I haven't locked in. I'm a bit uneased. So if you want my advice, and here's what believe it or not, guys, I hope you're reaching out for your mortgage needs with us. We're a bank. All right. But we also are a broker. So how does this work? Well, I actually work at a bank. We are federally chartered, but we have 85 lenders that we can broker out loans to. So what I do is I basically look at your rates and look at your loan. I get all your loan information together and I look at it. Then I go to our bank rate sheets and programs. Does it fit? I figure out the program where you fit and the interest rates. Then what I do is I go to my broker channel. I have over 85 different lenders I scan the whole country with. And these are all some of the biggest companies. You've heard of every one of these. So I put your information into a database. It scans the whole country for me and tells me this place has a better rate and better program and better everything than, Dan, your bank. So what do? I just advise you, we're going to go to that bank and get your loan. Okay, that's what we do. I'm federally chartered, meaning I can do anywhere in the entire country as well as Puerto Rico. So reach out to us. Let us help consult you with this. You can always get some other options or some other, whatever. But what I ask you to do is call us. My information is right down below. I promise you, you'll get somebody on the phone, because when the phone rings and nobody answers, I go ballistic. Okay, so please reach out to us. I know it's concerning, uneasy, and whatever, but we'll at least walk you through what we think and answer any questions honestly for you. So that's that part of it. But thanks for asking those questions. Are we ready to buy in 3 years? I locked in rent for 5 years, 2 years ago. I'm not a bad gig. But again, what you missed, you locked in that rent for 2 years. Maybe it was perfectly due because you had a new job, a new family, a new career. You just got out of school. You're in school. Don't know the reasoning behind it, but let's look at it this way. Don't know where you live, but 2 years ago you locked in. So what did you may possibly lose out on? Well, you lost out on an interest rate that you probably would have got 2 years ago in the 3s. Okay, so now rates are in the 7s. That's one. Number two, house values are at least 30% to 40% higher. I'll just go 30% higher than where they were 2 years ago. So not only did you lose out on that interest rate, you also lost out on 30% appreciation, where the average home right now is, let's just say 300. So 30% of that is now 400. So you lost out on about 100,000 in equity on that property. And that's it. But maybe on your side of the equation, your rent is half of what a mortgage payment would be. Then you did good. But what I'm trying to do is just have you think these things through. Just don't say, well, houses gotta crash because they gotta. Well, they don't have to do anything. Let me get this off the screen so we don't have to share this anymore. Okay, so that's me on the screen. It was getting kind of confusing in the background. Let's go to the next question. But I greatly appreciate you guys' content. Again, if you would, let us know where you're coming from. So just post in there, California, Florida, Arizona, wherever. I just love seeing where people are coming from. And if you have a question, please try to put a Q in front of it so I know it's a question, just not a comment. I hate rent, hate apartments, better to own. So you could just see. Just look at the context we have in the chat box. Can you imagine the comments I get down below in YouTube where people call me either an idiot or a savior for providing them information that they now know how to do financing and how to buy a house, or maybe how to buy their first house, or maybe their first rental property. So I try my best, and I try to just give you guys the facts without sugarcoating it or with an agenda. So that's that piece of it. New message. I don't know if I can click this and just go down. I can. So I hate rent. Let's show this one. That's not true in Florida Panhandle. It takes at least 8 months to a year to get a house built. Well, again, but what was it 6 months ago? So I just said it's going to take you about 6 to 12 months to build a house. So I think I defined that one, but maybe I didn't. So I'm saying in most areas, it's going to take about 6 to 8 to 12 months to build a house. You know, it's pretty hard to do it in 6 months because labor and everything else. And it depends on where you are, what time of year. Like if you're in Florida, they're not building this weekend. So you're going to probably add another week or 2 or 3 to it because the hurricane's coming or it's on its way. And I'm actually flying out tomorrow morning to head to Florida to my home down there. But don't ask why, but I just did it. So that is it. So I hope you guys found value to this. If you guys have any additional questions, please ask them. This forum was just put in place to explain to everybody out there, those who really want to know, is there a true difference between where we were in 2008 to where we are today? And there is a dramatic difference. And the last piece of this context, back in 2008 and 10, when everything imploded and everything went bad, banks did not want to give you a loan. They had more real estate on their portfolio than they had. They basically were trying to get mortgages. We don't want your house. We just want the financing piece of it. Okay. So that's in that day, the banks were going out of business. The banks, the big banks, you even have Citibank and Bank of America and all those that were in the brink of collapsing. Today's you don't. You don't, because the loans aren't defaulting because they're good underwriting standards. They have great rates. Almost 90% or 99% of those loans are on a fixed rate, so the payments aren't going to move. We're back in the day, back when everything crashed. Again, the mortgage companies didn't want to lend to you. Banks didn't want to lend to you because we were hoarding our money just to salvage ourselves. Today's market, we have the money. The loans are good. The loans are performing. Foreclosures are basically on an all-time low. So the banks have plenty of money to lend. Just nobody wants the money. So when you start seeing mortgage companies going out of business and everything else, they basically grew too much. They have way too much overhead for the volume that they're doing now because volume has contracted down to 25% of where we were last year. So a lot of companies can't get through it. I'm doing just fine. We are actually in the process of hiring new employees because we have a good amount of business coming in. So next thing we might have one more question, and then I'll leave it at this. We're on here a half hour. I just wanted to be on here for about a half hour. So just to explain this to you guys, should I lock in now or wait till Q1, Q2 of 2023? What are you looking to do? Because you just can't lock. You have to have a property or you have to be in the process of building a house or whatever. So let me go over 2 options for you guys. If you're building a house, which after today's video that I did and the research that I did, I think some of you guys might want to go back to those builders and say, hey, I'll take that house, but I want some huge perks because I know, I'm not paying you that amount for that house. So that's, if you're building a house, we have an extended rate lock. We have a 6-month extended rate lock that'll allow you to lock basically at no cost to you for that rate. Okay, so that'll go 6 months. We do have, they extend longer than that, but that is the primary loan that we have. The next piece of the puzzle, if you're buying a house or you want to buy a house, we can actually lock you in today while you shop. And you can take up to 2 to 3 months to find the property because we can have a 90-day lock. And then once you find the property, we can get you into that. But the one caveat here is that I want to talk about is, let's say we lock in today and 2 months from now, the mortgage rates plummet. They announce that we're in a recession. Everything's terrible. They admit it. And the mortgage rates, all the rates start to come back down. What happens? Okay, great question. Well, because we're a bank and a broker, I can actually move you. Let's say we were banking your loan at the bank and your rate was 7.25%. And all of a sudden rates plummeted. Now I can get you 6. I can't go back to my bank because we're already locked in. What I can do is actually take your information and we'll scan our nifty system, find out who has market rates at that time that we can move your loan to, and we'll move your loan over there. It's as simple as that. But if rates go up, you're locked in. You don't have to worry about it. You're already locked in. So let's go through one more question. We got a couple rate questions here. Lock and refinance once rates go down. That's exactly what it's saying. So again, I have a video coming out. It's a 2-1 buy down. Before you get negative on that, I did a lot of research and we created an Excel spreadsheet and a whole bunch of other things to actually show the value of this thing. And it is very, very attractive. And I'm going to be coming out with a video. That's what I would highly suggest that everybody does right now, because you're going to be really excited how this whole thing works. Next and last question. I'm going to leave it at this. I bought my house maybe not. Bought my house in 2017 at 3%. I'm all good. Thanks to you for all the good advice. Okay, so I might not be an idiot. So this person and they bought in 2017. If Regino, how much did you buy the house for? If you don't mind answering, and how much are you saying that, if you Google search it, how much is the house worth today? I'd be really interested in that. So not only is he at 3%, he's probably got pretty much good appreciation in that property. So we have a lot of people, millions of people that are high-fiving each other because we have record values of equity in homes, but we have the people that were sitting in the sidelines that are really frustrated at this point, and I get it. But unfortunately, you got to move with the times. So I don't control rates. I'm just providing information for you guys to make a wise decision. So, man, here we go. Regino, he said the house you put 400. How much did you pay for it? Is that how much you paid for it, or is that how much it's worth today? Let's go to the next one, and I'll go down to Regino. He's answering the question down below. How much does it lock? The lock will lock nothing. The cost, we can lock you up to 90 days, 120 days, 6 months at no cost at all. We can actually break it down. There might be some unique programs that might fit for you that you aren't aware of. Maybe a conventional loan is better than an FHA. I don't know your scenario, but those are the things we ask you guys to call. And then what we do is we ask you, it's basically a find fact mission. When you call in, we're just going to ask questions. Just like you're asking us questions, we're going to ask you questions. What are you looking to do? How much are you looking to buy? Where are you looking to buy? This and that. We're here to be your advisor. I don't want to just do the loan because, if you want to click and get through a loan, we like to be your mortgage advisor, tell you why, what, and where of what's going on with your mortgage and your transaction. So let's go from the next one is, when do you think the rates will settle down slow for refinance? So not until basically everybody comes out and admits that we're in a recession. So the last couple days actually threw me for a loop. I honestly never expected rates to hit 7%. I thought we would peak at 6.25. I thought actually we would have the year high at 5.5. Well, I thought that in 2021. I thought this year would be about 6. I never in my wildest dreams thought we'd be at 7. But again, there's a lot of pieces of this puzzle. We have, again, the Russian-Ukraine war that nobody expected. We had the supply chain issue that's still happening today. COVID's still an issue today. I get an alert every day. There's still 55,000 people a day get contracting COVID. So that's bad too. We have inflation running out of control. We have the job market that they're saying is robust. But I don't know about you guys. If you drive to work and you go past any manufacturing companies, do you see for sale or help wanted signs or hiring? I go past about 5 manufacturing companies each morning. Everyone, even one came out yesterday, said we'll give you a $2,000 cash bonus. So if job market is so tough, you get where I'm going there. So, but I think what we're going to see is not until Q4 and Q1 of 2024, where everybody's going to start realizing, man, the Fed and the federal government completely overblew this whole thing, giving out too much money, driving down rates, and it's going to implode. And you're going to start seeing rates at that point start to come back. Otherwise, we're going to go into a recession, then a depression. And I'm not joking on that. With these rates, the way they are, and the cost of everything going up dramatically as it is, and they're trying to force, basically the unemployment rate up and everything else. The Federal Reserve's doing a terrible job right now. So unfortunately, them and the federal government is a big fault right now, and just remember that. Thank you for your answering. You betcha. 400K. Did he ever come back? He said 400K. Let's see if he has anything down there. He never replied, so I don't know where that's coming from. DCA. Let's go to it. We've got a couple more questions come. That's what I told my boss to do. Go back to the builder and renegotiate. And he got 10K toward closings and a rate lock before the rate shot up for a week. He closed at the end. Perfect. So hopefully he's thanking you, and DCA, hopefully you guys, you're watching me, getting your information from me. So it's a win-win for everybody. So thank you so much. We got Michelle. Let's see what Michelle has to say. Hey, Michelle, what are the other components that determine the mortgage rate besides predominantly the MBS yields? That's, well, you got the MBS yield. That gives us the biggest component of that. And then you have the profit margin from the bank or the lender, whatever they need their profit margins to be. Then there's another component that's called LLPAs. It's loan level price adjustments. So that means, like I was saying before, if you have a credit score that's lower, it's going to come with a higher rate. So here's how it works. Let's say just hypothetically, let's say today's rate is 6. All right. But that's for remember, if you check out my videos on a daily basis, you always hear me say, well, this is for a client looking to buy a $500,000 house, putting 20% down, single family residency, The reason why I say all that is it has a piece or components of exactly what you're asking. Okay. So the loan level price adjustments are this. Let's say, again, I'm going backtrack. Let's say the going rate today is 6, but that's for a 740 credit score. You're buying a single family property. It's going to be your primary home. You're putting 20% down. I think that's the basis of that. So that's what that rate is. But let's just say you have a 720 credit score. So the LLPA, the loan level price adjustment, might say, well, there's an eighth to the rate. So now that rate is 6 1/8. Okay. So the next piece of this puzzle is you're not buying a single family home. You're buying a 4-unit building. Well, the 4-unit building LLPA is a quarter. So now we have the 6% start rate. We have the 1/8% to the rate for your credit score. Now we have a 1/4% rate for the kind of unit you have. Now your rate is 6.375. And the list goes on and on and on. Again, it's credit score. The biggest component is the credit score, the property type, how much money you're putting down. We call it the loan to value. Those are predominantly the biggest pieces of those puzzles. So they're called loan level price adjustments. You can even Google it to find out those, and it'll basically explain it to you and go through it in detail. It's pretty cool. That's why if you ever looked at a rate sheet, I had some old videos that I did that I actually showed people rate sheets. My rate sheets come across from some banks, and they might be 12 pages long. 12 pages long. That's why thank God everything is automated today, because you imagine going through the pages and it'll be like, this one is for you if it's going to be your primary home. This is going to be if it's a 4-unit. This is going to be if it's this. So it's really confusing. I mean, you don't have to be a brain surgeon, but you got to know what you're doing, because any screw ups are big screw ups. So I think we have, Regina, I got 400. It's probably, okay, there we go. So anybody sitting on the sidelines for the last 4 or 5 years, Regino just showed us he's got a 3.25% interest rate. He bought a house for $400,000 back then. It's worth $650 now. So he's got $250,000 in profit. So let's say his property value goes down $50,000. Okay, that's a pretty substantial adjustment. He's still $200,000 ahead of where he was. That's one. Number two, he's got a rate that probably we will never see in our lifetime again. So his payment is the lowest possible payment that could be imaginable. That's 2. Okay. So his alternatives would have been to rent. What if he been rent? What would his rent payment be today? Well, he would have started in 2017. So it would probably at least doubled by now. So he's in the catbird seat. So when I come out a lot of times and saying, hey, there's a lot of people out there high-fiving each other, I'm one of them. My house value has gone up substantially, and I got a 2.625 rate on my house. So I'm in a good position right now. So the next question we have, man, you guys, you loaded up at the end. So thanks. What percentage max of your net income do you recommend go over the mortgage, taxes, and PMI? So my recommendation might be a little different, but let me give you the guidelines first, and let me let you know what I would do. Okay, because percentages are tough. And let me explain this. So to qualify for a mortgage, you can't exceed 50% of your monthly income when it comes to the debt ratio on the mortgage type. So let's define some of this information. What we call the net income. You don't use the net income when qualifying for a mortgage, but I know there's like Javier and a lot of people out there go over calculators and can you afford this and that. We are working on basically programs like that to start coming on live to do some videos similar to Javier, what Javier does and other people do to, can you actually afford this house? Is this in your wheelhouse or not? But let me define all the things on the underwriting piece of the puzzle. And then let me give you my personal thoughts behind this. So in qualifying for a mortgage, what we call, and your question would be, what is the debt ratio that's allowed? So your debt ratio is this. It's your monthly expenses. So it's everything on your credit report, plus your proposed house payment, plus other things. But it's not like your cell phone bill and your heating bill and your cable bill and all these other bills. It's basically like if you've been divorced and you owe child support, legal pieces of things that you need to pay. You'd have to include that in there. But so they take all the debts, all the liabilities, divide it by your gross monthly income. That's your income that you get before all your taxes and everything are taken out. So you might say, hey, I make $1,500 a week. Well, you take home 15 bucks a week. How much do you really make? And then you look at your pay stub. Oh, I make 2,300 bucks a month or a week. So that's the number we use. We use the bigger number before all the stuff is taken out. So on a conventional loan, you can go up to 50% of the debt ratio. Okay, so that takes your house payment and all that, divides it by your income. 50.001 doesn't work. Doesn't work. It's automatically dead. Okay, then when you get to FHA will go to 57%, 56.99%. I'm just the messenger. I'm just telling you the guidelines. VA, I've seen VA up to 60, 62, 63, 64. It's crazy. But they have a lot of technicals behind the scenes because they have a disposable income calculator and a whole bunch of other things. And then USDA is usually 43 to 45 or so forth. So that's why a lot of times when you call in, we need to figure out what program do you fit into? Where's your debt ratio? Because if your debt ratio is 53, you can't go with a conventional loan. All right, you have to go with maybe FHA. So now let's get into the question of what do I feel comfortable with? Well, here's the tough thing of when you're using percentages. Okay, so if you're making $2,000 a month, a 50% debt ratio doesn't work because you're only going to, let's look at it that way. 50% debt ratio would put you at a 500, you make $1,000 a month. It means you can afford $500 a month in that payment. I know that I'm using these as low numbers for a reason. Okay, but that's your gross. So what would you net? Well, you might net $600. Okay, so basically, follow me in this equation. If you make $1,000 a month at a 50% debt ratio, that gives you $500 a month. You probably won't even net $500 a month, or maybe close to it. So that doesn't work. But on the other side, if you're making $30,000 a month and you're at a 50% debt ratio, well, you still have thousands of dollars left over. So it's hard to put a percentage sign on it. I always look at it as saying, okay, how much money extra do I have to afford each month? Do you realize you're going to have a cable bill? Yeah, it's probably going to be $200. You have your cell phone bill. It's going to be another $200. You're going to have an electric bill, water bill, sewage, garbage, this, that, everything else, maintenance, cutting the grass, gas for the tractor, gas for you get my point. So it depends. I would look at it as I would analyze it and just say, okay, this wouldn't work for me. But a lot of people, this is why I'm not a proponent of trying to, when we pre-approve somebody, approve them for the maximum they can get, because it doesn't work. I would never put, let's say, for example, my kids, I would never say to my kids, okay, let's get you the maximum mortgage you can afford. That'd be stupid. Okay. But it might not be in your situation. So I hate to defer to this, but it's hard to put a percentage on it. You need, let's look at it this way. You're probably going to need at least $1,000 a month just for all the cost of the house. Okay. So that might be a rule of thumb. What you might want to do is put your own budget together and see how much money each month do you have left? What would you be comfortable paying? All right. And that's where the number I would go forward with. So a lot of times my first question when I'm asking somebody about, pre-qualifying them is what payment would you be comfortable paying? Not what's the maximum payment you think you can afford? Or I'll get back with you, the maximum loan we can get you. And then think of it, we get you in that house, you better make those mortgage payments. And if your water heater breaks, you're not going to have any money to pay, but we don't care. We just want the mortgage payment. That's a pretty crappy way to go about it. So we want you to be, we consult you. That's why I say I'm a mortgage advisor. I always say that. I'm a mortgage advisor. Why? I want to coach you on these things. I want to say, do you think you could really afford that payment? It's up to you. You're the boss. When you contract us, you're the boss. You tell me what to do. I'll provide you with the information I think is best for you, and especially the why. Why did we pick that program versus this program? Why did we go that avenue versus this? And I'll tell you why. It saves you money. Look how much money it's going to save you over the next 10 years. Okay, it's substantial. It might not look like it today, but in the long run, you're going to be much better off. So those are how we proceed when we do a loan. So that was a long answer to that question. I apologize, but I don't apologize. You learned something there. So I got to quit apologizing. And this behind me, again, guys, I tried to do a green screen behind me because there's construction right outside my primary office. So I apologize for the bad video. I won't be doing this again in this office. Thank you for sharing your knowledge, Dan. We follow you daily to stay on top of the rates and insights. Thanks. Thank you. So reach out to me if you guys, especially if your teams or your realtors or whatever, reach out to me, guys. We have people calling in every day that need a realtor. We pre-approve them. What I hate saying is I'd love to be able to say, hey, you know what? Why don't you call so-and-so? There are people that follow us on YouTube. They know what's going on. We might have a relationship with them. We might not. But if you're a realtor out there, reach out to us. We had, I think, 3 or 4 applications today we pre-approved people with. And Nico and a couple other guys emailed me today saying, hey, do we have any realtors in this area that we can refer this to? If you're a realtor out there, email me. And my email address is, let me see if I can hide this and it'll pop up. I'll show it to you here. It's dan@therateupdate.com. So it's not down below, but it's dan@therateupdate.com, and it'll be down below in the description. So let's go to the next one. I hope I answered your question, but I again, that's what the rates and sharing knowledge. We follow you daily. Oh, I just got that one. So thanks again. You guys made me feel so good. I showed it up there again. So bear with me there. Egocentric, housing will crash because average Joe is not savvy investor who understands their low mortgage interest rate is an asset. I'm with you. I love my rate. I don't prepay my mortgage. Actually, I got a mortgage last year. I'm trying to, I didn't really need to. I was just like, it's basically free money, so I borrowed, I guess against my house, 2.625, and I put the money in the market. So when you see me do this on my thumbnails, it's because of the stock market, not the my mortgage rate. But the stock market's getting hammered too. Eccentric, what you got again, buddy? Let's see. Oh, you got a couple of them. Let's go through them. They will sell when they are forced to sell. Like I said, in today's market, if you're forced to sell, you should have equity in the house that you don't have to go through for short sale proceedings or foreclosure. So just, that's a plus there. Let's see what else you got. Eccentric, let's see. And the markets for buyers will be non-existent, which will force lower the asking price. Okay, got it. Thank you, sir. Next one is, this is a long one. Our current debt is $1,293 monthly for student loans and a car payment that will be paid off at the end of 2023. We will have an emergency fund. They plan on staying for 5 years. Is that too? No, not at all. Not at all. If the biggest key points I hear, so here's, if you could read that question. The house will be paid off, or the car is going to be paid off, but unfortunately you're going to need another car. In today's world, how many people are driving around a 10 or 12-year-old car other than me? But you have an emergency fund of 30 grand, fantastic. And you plan on staying in the house for 5 years. So even if we have a retraction of 10, 15, 20%, say, in housing, okay, over 5 years, you'll recoup that. In history, I don't know of any time, and I'm sure you guys can find me wrong here, but any time over a 5 or 6 or 7 year period where housing didn't recover other than the 2008 crash, other than that time frame, let me know. But I think, no, not at all. I think that is too risky. Let's go to the next one. Thank you for answering. So the other factors are individual circumstances beside the profit margins for the banks. Makes sense. Thanks. So hopefully that makes sense. But yeah, Google loan level price adjustments, or LLPAs, and you'll find out everything about that. Let's see. If our monthly mortgage totals after our down payment totals to roughly $3,160, we have a net income of $10,000, so you have a net income of $10,000. No, you're fantastic. So on yours, you have a net debt ratio of 31%. That's unheard of in today's world. Usually the gross debt ratio is 31 to 40. In most cases, it probably averages around 43. Okay, so you are under the market and you're using your net income, you're in a fantastic position. That doesn't mean you have to run out and buy today, but start doing your research, making sure, is your credit in line? Like in your situation, you probably have fantastic credit, but what I would ask you to do, just check. Just sign up for some service. I did create a website. It's called creditscoresandmore.com. Check it out. There's some free things there. The ones that I caption as free, don't buy any of the extra stuff. Okay, I'm a proponent of that. Don't buy. They're going to try to sell you all this life insurance, all that. Just use it for the scoring systems. Don't spend any money. It's free. So if you go to my creditscoresandmore.com, there's a thing that says free credit scores. It's actually a Vantage score. Use it. It's fantastic. I use the system. And then there also is a credit monitoring system. I use everything that's up there. I use personally, and that's why I created that account. But no, you're in a fantastic position. So when and if you're looking to buy, hopefully you reach out to us. I greatly appreciate it. So the next question is our current debt is $1,293 a month for, I think I just answered that. Yes, I just answered that. Sorry about that. Next question is, what should we do? Our rent is $1,705. It's a nice place. 3-bedroom, 2-bath, 1,500 square foot. We save about $8,000 a month. Our dream house will cost $3,900 to $4,000 a month. Should we buy or continue to save our $8,000 a month? Here, I honestly, I would hold. I would hold through December, January, February, and just see how much sellers are starting to freak out at that time. And then, but I would start looking now, or at least get with a realtor. That's another area we can help you. Get with a realtor to put you in their MLS search. So what you can do is you reach out. We'll help you reach out to a realtor, and you're going to give them all the information. Here's what my dream house would be. I'm looking for, this and that, and a, four bedrooms, 3.5 baths, a full finished basement, a 2-car garage. You give them your wish list. They'll put you in the computer, and every time a property that meets your wish list comes up, it's going to bing you or send you an email saying, hey, you want to check out this house? It's not a bad idea to continue to watch. You might have somebody that's getting transferred, and their company is saying, you know what, we'll pick up all the costs. We'll pick up that. We'll pay your mortgage payment for several months. We'll do this. We'll do that. And they're like, I don't give a crap. I'll just sell my house to whomever. You might get a good deal. But if not, you at least have your toe in the water that you can monitor and see what's taking place over the next 30, 60, 90, 120 days, because I think you're going to find a really nice sweet spot in December, January, when most people aren't wanting to move or buy. So great question. That's what I would personally do. So if anybody wants to yell at me, I'm just telling you what I'm going to do. Kyle, if you guys don't know Kyle of Win This House, he is the man. He's my man. He actually just started with us. He is now officially on the Frio team. So check him out. He's on Kyle is Win This House, the house you love, on YouTube. He does a fantastic job. I've been watching him for years and years and years. And I was able to contact him, and we had discussions for several months, and he found that he saw the value in what we offer and what we offer our clients and everything else. And he found that to be a great fit for him. So welcome aboard, Kyle. Love to have you, buddy. Next one on here is, what's the disadvantage of locking the rate? My loan officer said in order for you to lock the rate, your house has to be in contract. Well, that's that loan officer. Okay, we have a lock and shop. So meaning you can lock in right now before you even found the house. And that lock can be up to 90 days long. You can even go a little bit longer in some cases. So if you've been talking to that loan officer for a while now and they haven't locked you now that we're almost at 7%, shame on them. You need a new loan officer. And my information is right down below. We would love to help you. We can lock you in at the lock and shop. And again, I'll reiterate this again. If and when we lock you in, you aren't locked in forever. Okay. If rates plummet, trust me, we'll find a way to get you those current market rates that are lower than where we have you locked. That's one of the things that we live by. So thanks for that question. Now hiring signs everywhere in Phoenix. Now you're joining our market. I'm in Chicago or out in the suburbs of Chicago, and it is people are doing everything. There's bars offering pension plans to waitresses. So it is bad. So when they say it's a robust jobs market, it's not a robust jobs market everywhere. Okay. So what I try to explain to everybody is everything is regionalized. San Diego might be killing it right now, but Florida's getting devastated by a hurricane. So everything is relative to where you live. That's why I'm a huge proponent. Get involved, create your dream team when you're looking to buy a house. Use us. We are federally chartered. So meaning I can go anywhere in the country and help you. And then what we want to do is find a local realtor to help you. Because when you're buying a house, the realtor's free, if you didn't know that or not. So there's no reason why you would not use a realtor in today's market. Let's keep going. I'm going to go through, I always vow, I try to get through every one of these before I sign off. So I'd love for you to stick with us. If you got to go, you got to go. But thank you. Thanks for responding, Dan. We plan to invest into real estate long term, and this gives us knowledge of. Awesome. If there's anything else you need, please call us. And these are, this is basically how I even conduct my phone calls. It's question after question. I'm trying to learn who you are. What are you trying to do? Why are you trying to accomplish? I can be like Uncle Dan or something like that. That might be freaky, but I don't mean it that way. You can just have something, something to bounce ideas off of. I can be your mortgage, advisor on that. All right, let's go to the next one. But I appreciate all the kind words, folks. I really do. Dan, I have an adjustable rate mortgage at 3% that ends in 2024 and will then go up. Staying here another 10 years. Should I refinance now or wait until the rate expires? I'd wait. I would wait, ride it out. You're at 3%. Why would you trade in that 3% rate now to go at 6.5% or 7%? So ride it out and watch for that recession. Watch my my daily, YouTubes. Find that sweet spot when you start seeing rates dropping, and you will. Once the recession is confirmed, you will see rates coming down because just think of it. They've almost tripled in 12 months. I don't know of it ever happening in history. And it's going to have to counter here soon. So I would keep it. Don't refinance. I know I make money by doing loans, but I've never do a loan that I always tell people I wouldn't do a loan that I wouldn't do for myself. I would never refinance that 3% rate. Now, if you called me 2 months ago and the rate was 5.5, I'd be like, you might want to look to do something. Not now. Just stick with what you got. You'll be okay in a couple years. And I think this might be our last one. Last but not least, we have a VA pre-approval. Been looking since February. Currently renting month to month. Should we wait for the market to correct? And again, yeah, I don't know if you were on here when I said what I would do. What I would do is I put my toe in the water right now. I'd get a realtor. I'd even love to pre-approve you as well with that for that VA loan, just to so you can compare rates and programs, and you might even like us better. We might have more programs or something for you. Maybe not, but at least give us a try if you don't mind. The next piece of this puzzle is I would put my toe in the water right now. Okay, when I'm saying I wouldn't do anything till Q4 or Q1 of this year or next year. It's not that if I'm renting and my rent might be coming due in the next couple months or so, I'd put my toe in the water, meaning I would reach out to a realtor and say, here's what I'm looking to buy. Here would be my dream house. Okay, can you put this in your database and then alert me of houses that come up? You don't have to do anything, but see the houses that are coming up. Again, you might find somebody that just got divorced. They hate each other and they want to just dump the house just to spite each other. You might get a good value. You might have somebody that just got transferred. They might have got transferred from Florida to California, and their company's picking up everything and saying, we'll even pay your mortgage payment for the next year, or something like that. They don't care. They just want to dump the house. So you might find something. But what you're going to see is inventory continuing to climb, and rates are going to stabilize and start to ease. When that's going to happen is when the whole economy and when the federal government realizes, oh crap, we overdid it. Did you guys also know that a federal government shutdown is around the corner again? You're going to start seeing that on the news. So just an FYI. Let's see. I got two more. And like I said, I vowed to, we're starting to lose a lot of people. We're past an hour, and that's when we usually lose people. So my apologies. I'll get through two more and then I got to sign off. I'm currently building a process, rate not locked, and closing in November. What should I do? I'm 5% on the hook, located in Illinois. I'm in Illinois. I'm actually in Naperville right now. So please call us. Jose Alvarez, I would love to help you, walk you through. So give us a call at the 800 number right down below. You'll get one of my guys. What they do is they're going to answer the phone, and basically it's a fact-finding mission. They're going to get all your information, then they bring it to me. And then I put the plan together, and then they'll call you back and say, okay, here's what Dan suggested we do. Doesn't mean you have to do it, but it's what I would do and what I would recommend. So please give us a call if you don't mind. Let us walk you through some of these pieces of the puzzle. So we got more and more coming in. I'm going to try to get to these guys, but I don't know if I can get to all of them. I got several things. I even got payroll to do. Believe it or not, these guys are going to get mad at me if I don't do payroll. Next thing of the puzzle is closing in 60 days. Do you think rates will come down a little bit by then? It depends on when you locked. So if you haven't locked yet, please reach out to us. Okay, what we're going to do is, again, you might be with one lender or whatever. We're going to scan the whole country, and we can scan this for you basically every day. and we're going to go in and scan it and scan it and scan it, try to find you a sweet spot. A lot of times lenders will come up with specials. You guys don't know about it because they don't advertise it to you. Based on the volume that we do with a lot of the companies and the volume that they're not doing right now, a lot of times they'll come up with us, say, hey, we'll have a promotion this month of X or something like that. So we might even be able to find you some promotional products where we can fit you in to save you a lot of money as well. But what we can also do, depending on your situation, is we might want to look at other options like a 2-1 buy down, an adjustable rate, because I'm still a strong proponent of the Federal Reserve is going to start reducing rates Q1 of 2024. Let's see, the next piece of the puzzle is appraisal is coming to the finish line. Thanks, Dan, for all your help. And you betcha. Oh, hey, Matt. How you doing, buddy? Hope everything's good. So Matt is using our services right now. So thanks, Matt, for joining us. Greatly appreciate it, buddy. And let me know, Jennifer should be reaching out to you probably in the next couple of days once we get that appraisal back in. Let's see, the next one is, I'm going to do this. Where is the rental market heading? Do you think it will continue to go up? I think it's going to basically stabilize. But here's what's happening. You know how everybody's complaining why all these big investors are coming in, swiping in, and just buying up neighborhoods? Well, they're not dumb. So they've done that over the past several years, and they got good values based on the timing that they had, and they got good interest rates. So now they're in the catbird seat. So now it's completely a supply demand issue. Okay. So it depends on your local market, how hot that market is. Is there more and more rentals coming up? Is there more being built, or is it basically stagnated and you only have, X to choose from? It's like when you go to college, you ever send your kids to college and you start looking for rentals, you get this complete crap house and it's $1,500 a month because there's nothing else to rent. Okay. So that's how it works. So thanks for the thumbs up, Matt. And let's see, closing in December. Did I do that one? Last one, and then I got to go, folks. Closing in December, I locked in at 5.5. The builder gave me 75 in closing costs, but it's 210 days ago. Now they're offering 10,000 for new contracts. What can I do? Located in Virginia. Go back to them. The tough thing in those is the contracts that the builders use, they are so skewed to benefiting them and not you that you probably can't get out of that contract without losing all your money. So you're getting 7,500, you can ask them for the extra 2,500 bucks or whatever, but they'll probably tell you no. It doesn't hurt to ask, but they might realize that, well, you know what, you're under contract. If you walk, you're going to lose everything anyways. You ain't going to walk. So you might have to kind of play their bluff a little bit, but that's what I would look at doing. So, and also reach out to us. Maybe there's options that we have on the financing piece of the puzzle that you don't have. Okay, one more, and this is it. Is it good to get a HELOC? Is it variable fixed rate? So it depends. I have a home equity loan, second mortgage on my house with a zero balance. I just like having it there in case of an emergency or something's needed. But I would get one, and it's like a credit card. So think of it that way. It's a credit card that you don't have to use. We do have a new product coming in. It's a first or second lien position. It's actually called the all-in-one program, where you can actually get an adjustable rate mortgage as your primary mortgage that has a sweep account with your checking account. And it's a fantastic product, and I'm going to work on videos to explain this loan program to you guys. Those are all the things that I'm working on in the background. So that's it, guys. I got to go. It's been over an hour, and I got a lot of people chomping at the bit for me to answer some questions and to go review some loans. So I greatly appreciate it. I hope you found value in this channel. If you do, all I ask you to do is give us a thumbs up, subscribe down below, hit the bell. Every time I post a video, you get an alert. So I don't do a lot of live events anymore, and I greatly appreciate it when I do. There's all you guys coming and visiting me. So thanks again. And if you need any assistance, all our information is right there. You can check us out at the